reality became expensive. At some point, reality itself became expensive. Not luxury, not yachts, not penthouses, just normal life. A small apartment, groceries, electricity, insurance, a used car, and a simple night out somehow became things people now carefully calculate before saying yes to. A few years ago, most people believed inflation was temporary. But then housing prices exploded, food costs surged, rent climbed higher, energy bills spiked, and interest rates rose at the exact moment people needed relief the most. Now millions of people with decent jobs feel permanently behind, even though the economy supposedly looks healthy on paper. And that's the strange part. Officially, unemployment is low, markets are strong, and governments keep telling people the economy is stabilizing. But ordinary people feel something very different every single day when they open their banking apps or walk through a grocery store. Because this isn't just inflation anymore, it's something deeper. A slow separation between the real world and the financial system built on top of it. And once you see how the system actually works, you start realizing something deeply uncomfortable. The economy may no longer be designed for ordinary people to win. The money changed, and modern society runs on invisible promises. Promises that salaries rise over time, that hard work creates stability, and that life gradually becomes more affordable as economies grow. But underneath the surface, something fundamental changed after the 2008 financial crisis. When global markets nearly collapsed in 2008, governments and central banks stepped in to prevent the financial system from imploding completely. Banks were failing, debt markets were freezing, and entire economies were on the verge of collapse. So governments started creating enormous amounts of money to stabilize the system. At first, these measures sounded temporary: emergency support, short-term intervention. But the emergency never truly ended. Interest rates stayed extremely low for years, borrowing became cheap, and debt quietly became the fuel powering the modern economy. Companies borrowed money cheaply, governments borrowed money cheaply, consumers borrowed money cheaply. And because money was suddenly everywhere, asset prices started rising almost non-stop. Stocks climbed, housing exploded upward, crypto surged, luxury goods appreciated, and even collectibles became investments. But there was one major problem. Wages didn't rise at the same speed. The asset economy. You might be wondering, if trillions of dollars entered the economy, why didn't ordinary people become richer too? The answer is because most of that money entered financial markets first, not everyday life. When new money flows into assets, the people who already own assets benefit first. Homeowners become wealthier on paper, investors see portfolios grow, and corporations gain access to enormous amounts of cheap capital. Meanwhile, younger generations and working families are left trying to buy into systems that have already inflated beyond reach. That's why someone earning a good salary today can still feel poorer than their parents did decades ago. The game quietly changed while everyone was still following the old rules. Working hard still matters, but ownership started mattering far more. Housing is probably the clearest example of this transformation. For previous generations, homes were primarily places to live and raise families. Today, homes are increasingly treated as investment vehicles designed to store and grow wealth. Global capital now flows into property markets because real estate became one of the safest places to park money in a world flooded with cheap debt. And once housing becomes an asset class instead of shelter, prices stop reflecting local salaries. They start reflecting global wealth. That's why ordinary apartments now cost absurd amounts in cities across the world. You are no longer competing against your neighbors. You are competing against investors, corporations, short-term rental markets, international buyers, and decades of accumulated wealth. The average person never really stood a chance in that competition. Everything is connected. And it's not just housing. Almost every part of modern life is now connected to giant global systems that most people never think about until something breaks. Take food prices, for example. Most people assume groceries become expensive because farms produce less food. Sometimes that's true, but modern food prices are also tied to fuel costs, shipping networks, labor shortages, global conflicts, commodity speculation, climate issues, and supply chain disruptions happening thousands of miles away. Modern civilization became incredibly efficient over the last few decades. Products move faster, companies optimize everything, and supply chains stretch across entire continents. But efficiency comes with fragility. When one part of the machine breaks, the effects ripple everywhere. Then came the pandemic, the moment the entire system started cracking in public. Governments printed even more money. Supply chains collapsed. Consumer behavior changed overnight. And suddenly, there was too much money chasing too few goods. Inflation exploded across the world. But here's the part many people still don't fully understand. Prices rarely return to where they started. Once companies discover consumers will tolerate higher prices, many of those increases quietly become permanent. That's why people feel trapped today. Even when inflation slows down statistically, the actual cost of living remains dramatically higher. Grocery bills don't magically reset. Rent doesn't reset. Insurance doesn't reset. Reality itself permanently moved upward in price, while salaries struggled to keep up. The debt trap. Then central banks tried to stop inflation by raising interest rates aggressively, and that created an entirely new problem. For over a decade, modern economies became addicted to cheap debt. Entire lifestyles were built around low interest rates. Cheap mortgages allowed people to buy expensive homes. Cheap loans allowed businesses to expand rapidly. And cheap credit made consumer spending feel almost limitless. But when interest rates rise quickly, the pressure hits everything at once. Mortgage payments increase, business borrowing becomes expensive, credit card debt grows faster, and companies suddenly start cutting costs and laying people off. Now, people feel squeezed from both directions simultaneously. Prices remain painfully high, but borrowing money is no longer cheap enough to soften the blow. It feels like being trapped between inflation and recession at the exact same time. And maybe the most dangerous part isn't financial, it's psychological. People are starting to quietly lose faith in the future. Not dramatically, not overnight, but slowly and consistently. People delay buying homes, delay having children, delay marriage, delay travel, delay major life decisions because stability feels permanently out of reach. Entire generations are entering survival mode while still appearing functional on the surface. Economies don't just run on money, they run on belief. Belief that effort eventually leads somewhere better. Belief that stability is possible. Belief that tomorrow can improve. Once people stop believing those things, societies become unstable in ways statistics can't fully measure. The age of distraction. You can already feel the emotional exhaustion spreading online. The frustration, resentment, burnout, and quiet panic aren't just about prices anymore. People feel like the social contract itself is breaking apart. Technology is making the situation even stranger. Artificial intelligence is increasing productivity rapidly. Automation is replacing more tasks, and companies are becoming leaner and more efficient every year. In theory, technological progress should make life cheaper and easier for everyone. But historically, the benefits of technological revolutions tend to concentrate upward first. Productivity rises while ordinary workers increasingly feel replaceable inside the system. That creates a terrifying contradiction, where society becomes wealthier overall while individual people feel poorer inside it. And when people can no longer afford reality comfortably, they start searching for alternatives. Financial gambling, endless scrolling, online escapism, extreme politics, fake status, and digital distractions all become ways of coping with systems people feel powerless to control. You can already see entire industries forming around distraction because distraction is often cheaper than ownership. Streaming replaces going out. Renting replaces buying. Subscriptions replace permanence. Experiences replace assets. Modern life is slowly shifting from ownership to access, and once you notice that trend, it becomes impossible to ignore. The slow collapse. The collapse doesn't usually happen all at once. That's the part movies get wrong. Real collapses feel gradual in the beginning because people adapt slowly to worsening conditions. People normalize smaller apartments, more debt, higher stress, longer work hours, and lower expectations. Each individual sacrifice feels survivable on its own, so the overall decline becomes difficult to notice in real time. Eventually, the abnormal starts feeling normal. Entire generations grow up believing financial anxiety is simply a permanent feature of adult life. And once a society adapts psychologically to decline, reversing that decline becomes incredibly difficult. Now, to be clear, this doesn't mean civilization suddenly ends tomorrow. The world is not about to instantly collapse into chaos, but it does mean something important changed beneath the surface. The economic rules that built stable middle-class lives during the last century may no longer function the same way going forward. And millions of people are still trying to play a game that has already changed without realizing it. The people adapting fastest usually understand one thing earlier than everyone else. The modern system increasingly rewards ownership over labor. Ownership of assets, businesses, technology, attention, distribution, and platforms matters more than simply working harder inside traditional systems. Deep down, people can feel this shift happening even if they can't fully explain it yet. Final thoughts. And maybe that's the most unsettling part of all this. Most governments cannot fully solve the problem anymore without creating entirely new problems somewhere else. If they print more money, inflation rises again. If they raise interest rates, economies slow down. If they cut spending, people suffer. If they increase spending, debt expands even further. The machine became too interconnected, too leveraged, and too dependent on constant growth to slow down safely. Because reality becoming unaffordable isn't just an economic issue anymore. It affects relationships, mental health, politics, trust, birth rates, and entire cultures. Once ordinary people begin feeling permanently locked out of stability, societies start fragmenting in unpredictable ways. History has shown that many times before. And maybe that's the real story here. Not that civilization is collapsing overnight, but that modern life quietly crossed a line where simply participating in society started costing more than most people expected. For the first time in decades, millions of people are asking the same uncomfortable question at the same time. What happens if the future no longer feels financially possible? Because the scariest collapses are rarely the ones that happen instantly. They're the ones people slowly learn to live with. If you enjoyed this video, subscribe for more stories exploring the hidden systems quietly reshaping modern life.